Morning, everybody. To those of you here in New York, welcome. And to those of you online, a double welcome. So wherever you're checking in from, across the U.S. and maybe across the globe. So it's great to have you. My name's Joe Burgoyne. I'm lucky enough to be part of the OIC team, many of whom who are represented here today. So I want to thank you for coming out to join us, for 3 presentations about the wonderful listed options product. My colleague here, Al Brinkman. Al, you want to say hello?
Good morning. Again, welcome. Thank you for taking time out of your busy schedule this weekend to join us for our option spread presentation. My background, and actually I'm representing the New York Stock Exchange here today as part of the OIC, utilizing the exchanges for instructors across various the options play. My background, however, has been on the Philadelphia Stock Exchange, as has Joe. We know each other very well. We've been together for 20-plus years in the business. So my entire career was spent, the first part on the floor of the exchange and the last part on the staff of the exchange, doing a lot of option presentations and a lot of marketing for option. So, but in this case, I've retired, and I was fortunate enough to be asked by the New York Stock Exchange to represent them as an instructor for this event. So with further ado, back to you.
All right, Al, it's great to have Al. And I must say, I was sitting there getting ready to go, and our first presentation is going to be defense can win championships. Well, Al just said we're from where? Philly. Hey, how about it? That's the Philly special right there, Anyway, enough of that business. I'm sorry. Proud Philadelphia, and we love this, we love our Eagles. They got their ring 2 nights ago. Anyway, enough of that. The listed options product, really, it's a great product. It's a lot of benefits, a lot of risks. I think that's why you're here. Like-minded people get to meet one another, talk, learn. And of course, our industry disclaimer, which everybody gets, characteristics and risks of standardized options, is something you actually should check out. There's a lot of good information in it. We are in the process of celebrating our 25th anniversary this year. I've been lucky enough to be part of OIC now for 9.5 years. And as Al said, my background also is Philadelphia. I was an option specialist down there for over 20 years and just love the markets. It's an absolute pleasure to be able to trade the markets on a day-to-day basis. So we try to bring some of that knowledge to the OIC. As you know, we do live events, simulcast podcasts, and we have a really very comprehensive website that if you haven't been there, I would urge you to check it out. For those of you who've heard me present before, this is one of my very favorite slides. This is Americana right here. 1973. The listed options business did not exist. We started in Chicago, 16 companies. The first 4 years, no puts. I don't know whether you knew that. The SEC did not approve the trading of puts until 1977. So we started with 16 companies, 928 contracts traded in April of 1973, and lo and behold, look at the increase in volume in the listed product. I was on the floor. I started actually in Philadelphia in 1980. So I was down there when, that bottom left-hand corner, 0.5, that's 500 million contracts. We didn't trade 500 million contracts the entire year until 1999. We had the spike in volume in 2011. That August, we traded over 500 million contracts. That month alone, that was the month the U.S. lost its AAA credit rating. So, you go back to the late 99s and 2000s. Why did volume take off? I think a couple reasons. Electronic trading. Those of you who are familiar with the old ISE, now part of the NASDAQ family, first electronic access to the marketplace. Hit the button, get a report. Back in the old days, Al's a broker, me as a specialist. You call the person on the floor, they call their broker, you're lucky to get a report in 30 minutes. Now it's hit the button, and if it's almost not instantaneous, you're maybe calling your broker and saying, what's up? So we had electronic access to the markets, and then I think many of you do know, from 73 to 99, if you wanted to trade an individual listed option, you could only go to one of the 5 exchanges. That changed in 99, actually in Philadelphia, Dell Computer was, that was back in the late 90s when we had not the Nifty 50, but the tech bubble, and all kinds of business in Philadelphia. The exchanges one day decided we're going to list. And I think it was maybe out 2 months later, all the good products were dual listed on the various exchanges. So we had the combination of electronic access and more competition. And personally, that's what I think started to drive option volume. To the point where we're doing $500 million a year to now consistently we do north of 4 billion contracts. And think about recent history now. The markets up until, say, the last 6 to 8 months, you kept hearing about, no volatility, no volatility. Option volume, you can see, sustained in this 4.2, 4.3 billion contract level, which equates to almost 17 million contracts a day, despite historically low volatility. We got the volatility. The early part of the year, we were doing 23, 24 million contracts a day. Now I think year to date, we're averaging just south of 21 million contracts, on a daily basis. So a little bit about the history. I think like I say, I think that's Americana. It was an industry that started with nothing, and now, it's just, we're pumping out, 20 million contracts a day through this industry. So it's a dynamite product, and that's what we're going to get to talk about here. 5 parent companies: SIBO, NASDAQ, BOX, MIAX, and New York. Many of them have a number of different exchanges, and that's kind of history. So we will today, again, this is the first presentation, we're going to talk defense. So risk management. I'll get into protective puts. I'll talk about covered calls. I'll talk about the collar. We'll talk about a stock repair strategy. And by all means, questions are welcome. All right? No bad questions here. So I think, with that, Al, should I turn it over to you and the whole idea of risk management?
We can do that.
Okay.
Make sure I turn in all my stuff. Okay, I think we're up and running. Thank you, Joe. And, I share Joe's enthusiasm for the options markets. I started a little earlier than he did on that chart. I started in the options when Philly started in 1975. So for the next 34 plus years or so, I was connected with the Philadelphia Exchange and options. And I think really what drives this, and a lot of that, besides the education that's provided, obviously, for the retail investor to get used to it, is the mainstream product and the versatility of options. Is the ability to take combinations of options, which we're going to talk about extensively today, and achieve or do certain investment objectives in this. So we use these, again, more ways. You have your market research, and honestly, you know as well as I do, this all starts with your basic research. Starts with your basic research of underlying securities, exchange-traded funds, broad-based indexes that you're looking at. What is your view? What is your feeling about the future of this product? In that case, then we can take it and we can translate it into an options-based strategy to take advantage of your forecast. So you'll hear me quite extensively today refer to, it all comes down to your forecast. And that means when we put on an option position, what do we do with it? How do we manage that option position? Forecasts can change. Market conditions can change. I think one of the broad-based things here is it's been said that 80% of the risk, 80% of the risk in a stock is the market, not the stock itself. So while you're doing that, let's keep in mind we do analysis on an individual stock, ETF or index. We got to look at the broad market around it at the same time. So that's what we do. So we're going to talk about things today: income generation, risk reduction, not so much a little bit on stock acquisition, but it is part of the strategies. You can use options to bring stock or move stock out of your portfolio. All right, let me see if I can get, there we go. So we're going to talk about defense, risk management in the portfolio. Reduce it or remove it if we can. Ideally, we'd like to remove the risk from our portfolio. That's a tall order to remove all the risk from the portfolio because we have many elements, the market, the individual stock, and such, especially in today's geopolitical world. We can use the option to provide an insurance policy, and we're going to focus in on that with the next couple strategies we talk about, is an insurance strategy, is utilizing the option to insure pieces of your portfolio and under different circumstances. I'd like to say we can use these options in the risk management to put what I call the I'm able to sleep at night factor. Because I have these stocks in my portfolio, I can do an overlay situation utilizing options that at least mitigate some of the risk of these positions that could occur in the marketplace. The first strategy we'll talk about is the protective put, the pure insurance analogy for the options world. That pure insurance analogy. We talk about we insure our home, we insure our car. Best thing ever, of course, is the fact that we don't have to use that insurance. But we need to have it just in case. Same situation with the protective put strategy. Why would we do it? I'm bullish on a particular stock in my portfolio, but stuff happens. Stuff happens in the marketplace. I like the stock. Everything looks good with the stock. The earnings are continuing to be good. Patterns are good. Chart patterns are good if those of you are doing technical analysis and all that sort of thing. The board of directors, nobody's been indicted recently, so everything's good with all this. But there's the possibility out there. There's that uncertainty out there. So how can I insure myself and insure this stock, even though I like it? We use the protective put. By doing that, we establish a price by buying the put. And let's digress for just a second. Buying the put. What's that give me the right to do? Right to sell the stock at the strike price of the put at any time between the time I buy it and the time it expires. The option expires. So we have in our mind, okay, that's what we have. So by doing that at a particular strike price, I've established the floor. I can sell my stock at that price. Okay. Now we keep in mind the mathematics. We had to buy the put. We had to pay for the insurance. So that's a little bit of a deductible. But we can pick our spot. The other way to do it we're going to talk about is using it as a portfolio insurance, using protective puts to insure parts of our broader portfolio rather than individual stock. So let's get started on this. Downside protection. Your profit still remains in that long position you have, that long stock, let's say, that underlying stock. If that stock continues to go up, great. We don't have to use the insurance, and we're in good shape with that. Once again, where we buy that put, the strike price of the put in relation to the price of these underlying stocks sets our floor, our exit. Think of it as the deductible on your insurance. Think of it as a deductible. Okay, I'm willing to absorb this much risk, but after that, no, don't want to absorb any more, okay? So you can decide to do a full stock position. You can do part of it. Entirely up to you and your forecast in the market. And that uncertainty factor that's out there. What might happen? What is hanging out there? And I think you'll all admit in today's wonderful world with geopolitics and what's going on, that factor looms large. News events happen quickly, didn't see that coming, that type of stuff. Time is money. How much time do I want to buy my protection for? The further out we go, the more we're going to pay in premium. That's the way options is, because you're buying time for the coverage. So the greater the protection, if I want 100%, the cost will be a bit higher if I only want to protect 50% of the position. If I only want to hedge 50% of the position. So let's take an example. XYZ, our good old favorite stock that we have, if they ever come up with a symbol of XYZ and list the stock with that, all of our presentations are done. We have to start all over again. Anyway, the investor is bullish Obviously we are. We're long the stock position. We'd like to hold it. Things look good. Stock's been good to us and that type of thing. I'm long 300 shares of this particular XYZ stock. It's trading at 100. I bought it at 95. I'm looking good. I've got $5 profit already. I still feel comfortable about the stock, but I still have some concerns about something happening that could take away that profit very quickly for the stock. So I look and I say, well, I got 60 and 90-day options. So we look at this particular chain and we look at the bid and offer for the different strike prices. We're showing the 90s, 92.50s, and 95s here to give you kind of a range. So we could go in at these different levels for protection and we can see what the different costs would be. The 90 put, for example, if we bought that at 80 cents, hey, that's not too bad, but we're back to where we started. Okay? In fact, we're below. We're taking a little too much off the table there with that. So in this case, the decision's made, let's buy 3 90-day 92.50 strike puts for $2 each for $600. So we've paid a $600 insurance premium. We've taken on, by buying the put, the ability to get out of this stock at 92.5. Should the stock collapse and it come down. The beauty of it in a broad picture is the fact that we have the right to make that decision. Meaning that markets have hiccups. Not necessarily something that's long-term, breaking a trend or whatever it may be. There's a hiccup and the market comes down. And our stock is taken down with that market because it's just part of an overall market decline. We still like the stock. There's no reason. We still don't see anything out there that causes any concern. I've got the right for 90 days to sell it at 92.50. I don't have to do that right away. I can hold on and see. Regardless, if it continues in the trend, market trend, or it breaks and the trend starts down, and it continues down, I still got 92.50 right here that I can say, okay, we can exit the trade. Now keep in mind we paid $600 for the insurance. It's cutting our profit down a bit. But we do have that ability to exit should that stock continue lower and lower. So if it goes to 90, 89, 88, we're okay. We can get out at 92.50 and we've mitigated that risk of that decline in the stock. Because the risk in the portfolio will always be the stock in the portfolio. And we can see in the chart, we kick in at 92.50. And we've basically, at this case, we've got a limited, or we've defined our loss. And that's one of the beauty of what we're going to talk about with the spreads and stuff, is defining parameters on both sides. We know what our potential loss is. We know where our potential gain is. In this case, if that stock continues to go up, we're long the stock, it continues to go up. The answer to that is roll it and buy another protective put to lock in more of the profit as the stock continues up.
So I understand it, but the second column there, 92.50 put profit loss at expiration. Let's say the stock did go down to 85, the bottom over there.
Right.
Do I need to do something? Do I need to exercise that option, or at expiration I get that money?
No, you're going to have to make the exercise.
Exercise it the day it expires.
Right, you're just going to say, exercise that, I'll lose the stock.
Make sure I understand it.
Yeah. It'll be in the money at that point in time, and it will be subject to automatic exercise. So technically, you wouldn't have to do anything, but my advice would be to double check and make sure everything's going the way you are. Correct. A little more graphic presentation for those of us that like the visual rather than the chart type scenario here. And you can see your break even at expiration is $97. On this, obviously 95 plus the premium paid, 97. And the maximum loss, the premium paid for the put, plus the difference of the stock purchase price and the strike price. So that's the maximum loss that you could occur if that stock goes and you exercise the put, exit the stock for whatever reason. So think about the protective put in a couple of different contexts. This is one where you have a stock in the portfolio you're comfortable with. Perhaps you have a nice little profit in it. Maybe it's a stock you've had in the portfolio for a considerable amount of time, and it's come up for you. So you can, once again, make that decision. Head some part or all of it. Keep in mind that it is a term insurance policy because the option has limited life, and that's a key element in making decisions in choosing an option is that time frame. You have a limited life, but the longer life you give it, the more it's going to cost you to do. And you can roll that protection out and continue it in place, moving it up as the stock goes up. The other thing you might want to think about with a protective put is execute a protective put as soon as you put a stock in your portfolio. Just a thought. We don't have any profit in it, but you know what? I'm going to put this stock in this portfolio. The market's a little volatile. We got some volatility in the market. I'm going to ensure I have an exit piece for this underlying stock. So I just buy the put simultaneously at the same time. So I know I have an exit on this stock because that risk is in the stock. It goes down 10 points or $1,000. By having the put, we could mitigate some of that risk. Let's talk about it really quickly from a portfolio standpoint. I've got a $100,000 portfolio, and when I look at it, hey, look, this looks like a broad-based index that's out there. We cover the broad market. Smart portfolio, we cover different sectors, we cover different areas on this. Or it looks like a particular ETF that is in existence today, of which there are many, many to look at across broad bases, narrow based, and that sort of thing. But anyway, same situation prevails to a degree. We're cautious on the market for the next 90 days. And I just don't want to see, I'm looking, what happens if we have a 10% or more correction in my portfolio? That's a reasonable amount of money out of that portfolio if it corrects about 10% or more over the next 90-day periods. So let's take a look at buying some puts in a corresponding ETF whose performance closely resembles the index, and therein lies the key element to this, is to be able to correlate and see how the correlation is between the movement of your portfolio in the overall market and the particular ETF that you think mirrors this. So they've got to be relatively closely correlated. You're probably not going to get 100% correlation just because the chances of you having everything in your portfolio that is in the ETF or vice versa, a little bit slim, but they're going to be close enough that if I use this as a hedge in this put option and my portfolio and the market starts to come down, this put option is going to hedge by the value change. So it is, it's not 100% accurate, but at least allows you to do that. The other piece of this type of thing with a portfolio is slicing out a piece of a portfolio that you may be weighted heavily in tech stocks. You may have a heavily overweight in your base portfolio of tech stocks. So let's go and say, let's just hedge that piece. Let's hedge the tech. They have a notorious volatility factor involved. Let me put some hedge in here. We've done okay with these, but I'd like to hedge it. So now we need to go and look for either an index option or an ETF option that correlates, again, as close as we can and feel comfortable with it, that we're going to have a tandem movement. So you could slice out a piece of the portfolio. You could elect to do the whole portfolio if you can find that. Or selectively different pieces. Most of our portfolios have some tech, have some utility, that type of thing, have consumer goods, that type of stuff. So we could do that, or we could just do each one. In this case, however, what do we need to do? We have a $100,000 portfolio. We want a protection 10% downside. Okay, we're going to protect $90,000. You see an underlying ETF trading at 250, 10% out of the money put. Okay, the price of a 90-day 225 put is $3 per contract. And really quickly, a good reference slide, how we want to do this. The portfolio dollars to hedge, 90,000. The notional value of the strike price, 225. Once again, everything represents 100 shares. In this case, times 100. That means we're going to need 4 puts to achieve our desired hedge in this case. So I purchased 4 90-day 225 puts to hedge $90,000 worth of risk in the portfolio. My 10% is my deductible. My downside, I'm willing to, 10% down move is acceptable. We'll go with that as a deductible. $1,200 premium is the cost of the insurance. And again, make the decision. You could do less puts or more to bring it up to the 100,000, or less to do it at 50% of the portfolio, for example. Same baseline chart that you're looking at, the put protection kicks in at 225 or lower. The beauty of this, again, is still the fact that you don't have to exercise your right on the put. You can ride out some market turbulence, but you've got the protection in your pocket. Take it back maybe to an individual stock. And one way that you could always protect an individual stock in the portfolio is put a stop order in. Just put a plain old stop order in. I want to sell it at this price stop. So if the market does come down to that stock price, the stop order executes and we're out of the trade. A couple of things happen there. One, what happens when it hits the price, touches the price? You're gone, you're out. The other piece of that is the price that you put the stop in and the price that you get may not be quite the same number in the marketplace. The put, conversely, you have control. You have the right to put it at that price anytime till expiration. So you're still in even if it touches that price. It's your decision, not the marketplace's. So with that, we've shown some little bit on portfolio insurance. We've talked about it on individual stock insurance for protective put. Think about it as an immediate protection when you put on a stock position. Buy a put to protect yourself on the downside. Once again, everything focuses on what you think. And looking at the prices, are they comfortable? A lot of factors we can talk about, which we will, about the pricing as we go through. Next one to talk about is the ever-popular covered call.
All right. So we want to build off the whole idea of insurance and the protective put. I'm guessing, well, first of all, how many of you use options currently? All right, solid 80%, I'd say. How many of you use or use the strategy covered calls? What do we think of with covered call? Do we think of defense or income generation? Income. Okay, I agree. So why is covered call in the defense presentation? Well, I think it's all about strike price selection. Okay, and we'll go through some examples. But conceptually, if you write or sell a call that is at the money or even in the money, you've got more downside protection. So that's why it's included here. There is protection. Depending on the strike you choose, that's going to define how much protection with the covered call. So the covered call, for those of us just getting started, you're long the underlying, and for each 100 shares of the underlying, you can sell one call. Because back to options 101, each call corresponds to 100 shares of the underlying. Oftentimes, the primary goal of the covered call strategy is income generation. But don't forget the side of defense. That certainly can come into play. And when we talk about covered calls, typically we're not talking about, if we think the market's going to turn around and crater, the covered call strategy is not typically the one we would think of first. What Al just talked about, the whole idea of insurance and protective puts, is I think where we'd go. But let's open our minds a little bit to this whole idea of covered calls from a protection standpoint. Al talked about rights and obligations. When we do a covered call, do we have a right or an obligation? Obligation, because we've sold an option. When we sell options, we collect cash, but we take on obligations. When we sell the call, we're taking on the obligation, as we know, to deliver the stock. Taking it a step further, if we sell a put, the obligation is potentially buy the stock. But those core concepts, rights and obligations that Al talked about quite a bit, really important to understand. What are the covered call writers' concerns? Question?
Yeah, on the other risk, you talked about the options being assigned.
The question for those of you online, are calls ever not assigned? And by assignment, we're talking about, the obligation that you have to deliver. So, talk to me. Are calls ever not assigned? Oftentimes they're not assigned. They're not assigned if they go out with no value. How many options expire out of the money? Lots of them. Lots of them. I don't know what the number is, but lots of them. So, if above the strike price, okay, this is question 1A, if at expiration, the call is a penny or more, if the stock is a penny or more above the strike, you get assigned automatically. So it's a penny above the strike. If we've got a $50 call and the stock goes to 55, but we have 3 weeks left, will we get assigned? Unlikely. Very unlikely, because there is still premium left in that option, time premium. And you not always, but almost always do not get assigned when there's time premium in addition to intrinsic value. Think about it, because the owner of the call, if he exercises, he gets the intrinsic value, the in-the-money amount. Agreed? If there's in-the-money amount and time premium and the call owner exercises, he gives up that time premium. So he or she would collect more money by selling the call in the marketplace that has in-the-money value and time premium rather than exercising that contract early. All right? So that's a little something about exercise and assignment. But good question. So what is the concern with the covered call? Is there any risk?
Yes.
What is it?
It's unlimited. You can continue to go vertical beyond the strike that you assigned that you set for it.
Okay, so the answer to those of you online was yes, there's risk. The stock can go vertical. That's not the risk side, though. The risk side is the downside of the stock, a covered call. Let's go back. For every 100 shares we're long, we sell one call. How much protection do we have with a covered call? Bingo. Thank you. The amount of downside protection is the premium we take in with the call we sell. It's that simple. All right? A lot of option concepts get the reputation, it's so complicated. Baloney. Many option concepts, just like this one, very straightforward. You're long stock, you sell a call, you sell it for $5, guess what? You get $5 of protection. You sell it for $10, you get $10 of downside. You sell it for 50 cents, you got 50 cents. It's that simple. So below the amount of premium that you take in for the covered call, that's where your risk is with the position. We good? That's it. It's covered calls. We'll go through a quick example, and then we're going to build on the protective put and the covered call into a collar. Okay, let's go. We're long XYZ, Al's favorite stock, 100 shares at $52. Typically, as we talked about earlier, we think of income generation with covered calls, but we can talk protection as well. In this example, we're neutral to slightly bullish on the underlying. We're long the stock at 52. We sell the 55 call. Is that call in, at, or out of the money? Out of the money. Good job. Out of the money by $3. So the stock has to go to $55.01 or higher for that call to be in the money. We collect $175. We got a covered call. All right? It's that. Before we go to that. If we get the stock at 52, if I decide, I don't like the market, but I don't want to sell my underlying, I'm going to sell the $45 call. Okay? The stock's 52. We're going to sell the $45 call. let's say we have 60 days. So we just got to guess about the time premium. Agreed? How much is that $45 call worth with the stock 52? I hear 7. I like 7 a lot. 7 plus what? Time value. Excellent. All right? So let's just say there's $1 worth of time premium with 60 days to go. So the value of that call is $8. Agreed? How much downside protection do we have? $8. Bingo. Okay? We're still generating income. How much income would we generate? Not $8, $1. The time premium was $1. Agreed? So we take in $100, but we've got $8 of downside protection. You with me? That's why we're talking covered calls inside of defense here. All right? In this example, we've sold the out-of-the-money call. It's straightforward. Stock goes from 52 to 55. We can make $300. In addition, we've taken in $175 for taking on the obligation to sell the stock. So we can make $475. Agreed? Downside protection, we have how much when we sold the call for $175? Well, how much downside protection do we have? $1.75. Bingo. So the price of the stock, 52 minus $1.75, our break even is 50 and a quarter. Make sense? That's it. Covered calls. So depending on that strike selection will define how much downside protection you take on. All right? So, different scenarios. What should we do if XYZ rises above 55 prior to expiration? Lots of different choices. If it's above 55 at expiration and we don't buy back the call, we're going to be assigned. What should we do if XYZ is unchanged at 52 at expiration? It depends. Maybe we sell another call. Maybe we thought the stock was going to go to 55. It didn't. Maybe we're a little nervous about this stock now, so maybe we decide to pick another stock. There are lots of different choices. And what should we do if the price of XYZ begins to decline sharply? What should we do then? To me, that's the question you really got to ask yourself first, because that's where the risk is. We know the risk with covered calls is to the downside. And so, what do we do? What do you think? Stock starts to tank. Buy back the call and sell the stock. You could buy back the call and sell the stock, be out of the position. You could buy a protective put, and Al's going to get into that shortly. You could roll down. I mean, a lot of you are, 80% of you are using options now. You could buy back that out-of-the-money call, buy back that out-of-the-money 55, and maybe sell a 50 or a 45, depending. But, ideally, and this is what many investors don't do, ideally, when you put the position on, it's damn easy to put a position on. The problem is when it goes against you. So think about that early on. That'll help you. It'll save you so much cash in the big picture if you actually have a plan and stick to it in advance for the worst case scenario. And this presentation is about defense. That's a mindset. We expect to make money. We hope we're going to make money. That's the goal. The challenge is, what do I do when I'm dead wrong? And how much money am I going to lose? That's what you want to, in my mind, think through all the time, because that's where the problem comes in. So with that, we've got the protective put. We've got covered calls, maybe as defense. And Al?
We're going to take a look at the collar. And a lot of what Joe said, I really like to emphasize a couple of points that I feel strongly about in this type of thing. And he talked about rights and obligations, and we talked about this before we went on stage. I feel it's really important because we're going to go through in these subsequent presentations a lot of different strategies that have different aspects to them. and all that. But the baseline, the absolute baseline when you're looking at an option strategy, whether it's the iron condor and got a different bunch of legs or it's just a long call, long put, at some point in time you need to step back, take a step back, and make sure you fully understand the rights and the obligations that you're undertaking when you put a strategy on. If I'm selling a put, what could happen? What could happen vis-a-vis the stock involved in this? And if I'm long a call, I got the right, just be sure. And I really want to emphasize it when we start utilizing puts. So I'm getting a little bit ahead of myself. I usually leave a little later, but the puts are almost counterintuitive. Because you're buying the right to sell something. It's like, okay, that's not quite right. And I remember, as Joe said, way back in the day when puts weren't around and then they came on, we were baffled enough on the trading floor then with call options and getting pricing on call options. When puts come on, everybody was really confused. And I really do think that we're still a little confused about those. So you need to take that extra time, and I like to say, take a deep breath, step away from the table. Okay, I'm doing this strategy and I'm utilizing puts. What rights and obligations? And understand, am I capable, am I wanting to have this happen? Stock delivered, stock taken away, give away stock, if you will, on this. And make sure you're okay with all that, which leads me to the other axiom that I like to put out there. Joe hit it. It's discipline in your trading. It's thinking it through. Once we've got the rights and obligations, let's sit down and outline in our mind on a piece of paper, however you like to do it, where's our decision points in this strategy? If, as he said in the covered call, the stock starts to move down, if that stock moves down a certain percentage, know ahead of time. Don't do it on the fly. Say, if stock loses 10% of its value, look at the marketplace, look at the underlying stock. Maybe I shouldn't be in this stock, but have a decision point. What am I going to do to manage this trade that I have on? Trade management. And it's a discipline that you need to develop over time. My recommendation, and this is just a little, we'll get into the collar in just a second. My recommendation is as you start to trade or you're starting to look at some of these trades in particular, practice. Practice makes perfect. Do the paper trades. There's the ability online, OIC, in a lot of places to actually put these trades in and change the pricing factors to see what expectations you might have. If factors change, price change, time change, volatility changes, get used to that. And as you do those, and if you do live trading, a lot of you are already trading, I hope, keep a trade log. Keep a real good trade log. It can be as detailed as you want. You no need to go over the top in it. Why did I get into this position? What was the market conditions when I got in? Due to what happened along the way? And we talked about defense, and we had the picture up there of the football playing stuff. What do football coaches do when they look at films of other teams? What do they see? What do they see? Tendencies. All of a sudden, if you keep the log and keep looking at it and you're doing particular trades and certain things are happening or you're making certain decisions, you'll start to see you have tendencies, perhaps, to maybe exit too soon, maybe not pick, maybe our strike prices could have been further apart or closer together, however that may be. But you'll start to see things, a pattern emerge, and you'll get a feel for your trading ability, and you can make some adjustments left or right with it, because that's what the coach will do. He'll make his adjustments with his team, with his defense, whatever, based on what he's seeing the other guys are doing. Well, this is giving you some introspection into what you do. Option collar. I said at the beginning, one of my favorite things with options is flexibility. We can take these and we can move puts and calls and we can put them in all sorts of different configurations to achieve various objectives. So in this case, we're taking a protective put and the covered call. We're putting them together and giving ourselves a nice risk management strategy called the collar. It's called a collar because we're going to put a collar around our stock, top side, bottom side. So the put, we already said, provides protection for the downside move in the stock. In a typical case, I would do the out-of-the-money put, get, like we said when we talked about the protective put, I'll put that deductible in. I'll have something on the downside to work with on that. I still like this particular stock, but once again, I'm going to go a little bit. I have some reason to think that it is maybe reaching its peak as well. There may be an upside piece on this type thing. So you've got that piece in place. On the upside, we do the covered call. So we put the covered call strike price out of the money where it's trading right now, above it. So we build in a little bit of profit if it goes up to that side from that piece. We have the protective put, so we've got a ceiling and a floor. That's another way you might want to look at this. On this stock, we've got the protection around it. And by doing the two options, we've bought one and sold one. Our net cost has come in. We get the premium from the sold, and we pay for the long side on that. Excuse me. So remember, what are our rights and our obligations as we go forward with this? I have unrealized gains. We know what our rights and obligations are. We can get out of the stock down here, and we will have to deliver the stock on the top side. We bought this, so that gives us the right. We sold that. We have the obligation on the call. So that's part of, again, let's talk about our strategy. Let's talk about that trading discipline in the plan. All right, what happens if my outlook on this underlying stock starts to change during this period? I've got this call sitting out here, this sold call, that means I'm going to lose the stock at this price, and I now like the stock. What am I going to have to do? You're going to have to make it up and cover this and buy it back. And chances are, in those circumstances, that stock has continued to move up towards that strike price that you sold. Your opinion, your view of the market has put you in a position where I really don't want to lose this stock. And this is exactly the same thing as if we just took the put off the table and said it was a covered call. It's the same thing we got to think about. I can cover this. I'm going to lose money on it because that stock went up. That call price is going to go up. I sold it here. I'm going to buy it at a higher price. But I still have the stock. So once trading decisions, your trading plan, there's no magic formula here. It's all you and how you feel about the underlying. Yes, sir. Question.
When the stock goes up and your call is already at the money, it makes your stock also goes up. You're losing money here, but
the stock is, yes. The question is, if the stock starts to move up, obviously you're making money on the stock. You're losing money on the call because the call price will start to move up as well. So there's an offset in there. But we talked about that exercise assignment type thing, and you got to look at it again. How much time is left before this call goes off, before it is exercised and your stock is called away? Decision points. I always talk about that in any strategy. You've got to have points, as I said. If the stock moves this much, if the market changes this much, if this goes, these are points where I have to step back and say, I need to make a decision. I may not say this is exactly the decision that I want to do, but this is, I got to do this. I got to make a decision at this point in time. Sir.
Here, I know when you sell a call, during that time period, the dividend is all yours. The person who owns the stock. If I sell it,
If I own the stock and I sell the call,
if I sell a call, the dividends go to me. The point down here is that receive key benefits, receive any dividend if not assigned on short call. I'm not sure, I don't understand that.
if you were assigned on if the question was not receiving dividends, if you're assigned on the short call. If you're long the stock, we're doing a collar on the long stock position. We're entitled at long stock for the dividend, any dividend on that particular stock. If, however, that stock rises above the price of the covered call, the strike price of the covered call, and is called away from you, then you will not receive any dividend on that. Option traders don't receive dividends on stocks. If you own a long call position, you're not entitled to a dividend. So if it's taken away from you, and that's a good question in the sense that's your decision point. If it's coming up on a dividend payment in the stock and you've got a covered call that has gone in the money and you could risk losing it, losing that stock and not getting that dividend that you want, you need to cover the call. Because once you get assigned, once that 1 penny threshold at expiration is broached, it's gone. It's automatically gone. The only way you can stop it is cover the naked or the open call position. Before you use that collar position very quickly, do I want that downside protection? I want to participate on upside for the underlying type thing, and I need to strike that balance between risk and reward. Keeping in mind that this type of strategy is one of those, I would say, you have a position that you've had, it's come up, you want to do the protective put from it, but for some reason your forecast is saying we might be reaching near a top, whether that be through technical analysis, whether it be through market trend, or however, saying we might be a market top, I'm looking at this area for that stock to top out at, and this will take me out of that stock if it goes through there. This is an example, real quick, of a zero cost collar. Chances are, maybe you could do one of these type thing. It probably will end up costing a little bit for that type of thing. We buy the strike, the 57 put. We sell the 64 call. We're long the stock at 61.50. So we've got the put. What do we got? We got the right to sell it at 57. We're going to lose it if it goes above 64. So we've put some upside positive in this, and we've got a little bit of deductible down on the bottom side. Question, sir?
Yeah. What about intentionally doing a collar for when the strike is going to go post-dividend? So you're familiar with the underlying. Like, for example, I'm trading, one particular issue. I've been trading it for years. So I just do a covered call out of the money. I know that it's going to rise to, let's say, 62.50. Initially, I have it as a basis of 60. And intentionally write a collar, knowing that it's got to go down at least $1 after the dividend's been paid out. So getting premium and profit on both sides of the trade, as opposed to being afraid to write the cover call during the dividend period. So intentionally doing a collar.
Intentionally doing the collar as it comes up on an ex-dividend date for the underlying security on that.
Right.
Thoughts?
Yeah, I mean, you just got to be careful about the div.
Yeah.
I mean, the question is, related to selling a call around the dividend for those of you online, and you just have to be aware of the likeliness of being assigned. Straight, to me, that's it.
The problem is with a lot of tech stocks, just as an example, is all of this is based on familiarity with the underlying. So if you're very familiar with the underlying, you get really pissed off because you're like, I know it's going to go to 62.50. I missed out because it's drilled in your head. Don't write calls during earnings. Don't write calls during dividends. And that gets in your head as a trader. And now you made the biggest mistake. You could have captured so much profit, and you're not getting paid for your knowledge on the stock.
And again, if I may, because we do have folks online, generalities. Don't sell options against certain types of stocks. Don't sell into dividends. You have to be careful about the generalities. Right. And I think for each of us out there, oftentimes every person has their own plan and their own generalities. So I think, due to time, because we're getting tight, I think we could talk about that a little bit more at the break.
Real quick, on the gentleman's point, he mentioned familiarity with the underlying stock. And that's not a bad thing to have. In sense of, instead of taking your trading strategy across a broad base, focus on a bunch of stocks you're comfortable with and see how they trade over time and get used to their patterns and practices, if you will, is certainly something that is worth considering. Getting good with a couple stocks and using your strategies that way. Zero cost collar, once again, we're getting a little tight on time on this. The shares settle below 57, the short call expires, worthless. The 57 put gets exercised, and we've sold the shares at 75. And we can go through these examples between 57 and 64. Both options expire worthless. Any profit and loss is where that number is between 57 and 64, because you're back with the stock. Okay, the options have expired worthless. They're above 64. The put is going to expire worthless. On that 64 call gets assigned. We lose the stock at 64. And if the stock is considerably above it, we've lost out a little bit on that side. But our forecast was we had a decision point there at 64. We made that decision for a reason to do that strike price, whether it be a chart pattern or historical highs for the individual stock, whatever that may be, we've already made that decision. All right.
Okay. We do want to be sensitive to everybody's time, both here and online. So we've got about 4 minutes to go through one strategy. Just to back it up a second, protective put. Covered call equals the collar. Okay, so that's hopefully the takeaway from the first 55 minutes. Next strategy, and it is a little more complex. I'll try to go through it, rather quickly. Stock repair. Okay, so basically we own a stock and it tanks. Not what we were hoping for. How do we help ourselves? Can we help ourselves with options? We could do nothing. Hope. There was a saying on the floor, and it still exists. Sell hope. I hope this sold. End of story. End of story. I mean, that's it. Sell hope. Double up. Depends on your risk tolerance. You want to double up? That's on you. Me personally, 23 years on the floor, I wasn't big at doubling up. That's how they carry out. All right? But some people like to double up. How do we establish stock repair? Again, we're long the stock, it goes down. What do we potentially do? We have no uncovered. Basically, what we want to do as the stock goes down. Say the stock's $70 and it goes to 60. All right? Stock's at 70, goes to 60. We decide, and we were long the 70 call. All right? Let's see. We got 100 shares at 70. It's now at 60. Stock loses $10. Okay, the strike increments are $5. So we got the 60s, 65s, and 70s. We got 2 months, we hope, for the stock to recover. We're going to get into a 1-by-2 spread. 1-by-2. Long 1, short 2. Okay, if we're short an extra option, do we have more risk? Heck yeah. If you're net short options, you have, on the call side, unlimited risk. On the put side, substantial risk. But we're long 100 shares of stock. So in essence, we're going to be long the 100 shares of stock, long 1 additional call, and we're going to sell 2 calls around the long stock and the long call we've bought. So what do we construct? Again, stock goes from 70 to 60. We turn around and buy, and we think it's 60. Okay, we think, we're not hoping. If we're hoping, we get out of the position. We think the stock, this is a hiccup, don't understand it, but we believe in it. We think it's coming back. So we've got the 100 shares of stock down $10. We think, it's down to 60. We think that's going to be a floor, and we think it can head back up. So we buy the at-the-money call. Decide on how much time you think you need. Our example's 2 months. We buy the 60 call. All right? And we turn around and sell 2 of the 65 calls. So we're long 100 shares of stock, long the 60 call, so that we're net long, 2 assets, and short 2 of the 65s. What is this accomplishing for us? Take a look at the graph. Okay? Right side. To the downside, we continue to lose money because we're still long the stock. But to the upside, okay, this is stock repair. This is not about making a lot more money, but it's stock repair. What we've done is lower our break even at 70, which is where we bought the stock, to now a $65 break even because of the 1-by-2 spread. All right? In the essence of time, we got to be, obviously that break even, which is 65 here, is going to depend on the price of purchasing the 60 call versus selling the 265s. But the whole point of stock repair, again, conceptually, you buy the at the money, you sell 2 out of the monies, and you're long that 100 shares of stock. The point of this is to lower your break even from, in this example, the $70 stock price that we originally had, down substantially to 65. So if the stock goes back to 65, rather than being down $500, we break even, and then you decide, what do I want to do? I want nothing to do with this stock. I'm in the game. I want to do it again. But we've saved ourselves $500. That's the point of stock repair. Buy the at the money, sell 2 out of the monies to offset, the original bad purchase in the underlying. So with that, I think we will wrap up round 1. Hopefully, we're going to come back in 15 minutes. Al and I are happy to take questions. We have some goodies for those of you here live.